We start with today's rally, and it was a hard-fought one at that. The Dow rallying 400 points at the open before turning negative, and then it was up and down throughout the afternoon before stocks took off into the close, ending the day higher by just about 300 points. That move capping off what was a wild week for the market. The Dow starting off slow, then we saw that big reversal midday on Tuesday. Though we only ended down 50 points, it started heavy selling into Wednesday and Thursday. Now here we are, higher yet again. But even with today's move, it was still the worst week since March 23rd.
Rawhide, Guy
Adami.
No, not rawhide.
Size it up.
Clint Eastwood's, I mean, rawhide.
Good, bad, and the ugly. Josie Wales.
Welcome, Scott.
Let's get him out.
Great. Let me preface this by saying I still think the market heads lower. However, today, when the market went negative after opening up some 400 points, I thought it was going to continue. So if you're bullish, you take a lot away from the fact that it staved off.
It's a good sign,
negative,
right? I mean, it fought back.
Closed right at the 200-day moving average. That gives the bulls a lot of ammunition going into next week. I'll say this. There have been countless times over the last couple of years where I thought, here it is, the market's about to crater, only for the market to sort of stave off defeat and add victory and build on it. Maybe we're at that point again. But I think it's different this time. I think the fundamentals suggest that there's more pain ahead.
Okay, so there should be reason to be nervous. And ultimately, although you think the market was constructive today, I think the whole reason that today was positive is also negative. In other words, complacency is what led us here. If you think about positioning, we got a University of Michigan survey out today, backward looking, so it hadn't fed into this data over the last 3 days from the stock market, but it showed that investors are as confident about the stock market as we were in January, a blow off top. So if you think about the velocity and the speed, the S&P closed in a 9-day RSI yesterday of 9.7. What does that mean? It's the lowest RSI closing on the S&P since 2001. I'm talking about not the financial crisis, so it tells you how overbought we were and how violent this was. I think people are still complacent, frankly.
That's the risk, right? So being up today, is that bullish? Does that give the bulls hope? In fact, it's the worst thing that could have happened. What we really want is to have another 3-4% down, and then you can maybe have some catharsis, some capitulation. Instead, you're like, hey, I didn't act. Guess what?
I feel good about that.
What about, we did have a 400-point reversal today.
We're at a multi-year high. We've dropped 5%.
I understand.
There have been 300 5% plus corrections going back to 1927. That used to happen all the time. This is nothing. We want it to go down.
Okay, it did go down is what I'm saying. The market opened very strong, which I hate. I hate a big, giant open where it just is just levitating. And then it, really gained steam on the downside. And that was a 400-plus point reversal.
Not enough
to me, the most bullish part, not where we opened, it was the rallying off the bottom. And if the market,
But that's complacency.
The fight back. Why is that complacency?
Because
maybe that's a sign that people got a little too negative too fast.
Well, what I think, and look, you can't deny the price action indicates this was violent. But those same people who are complacent are saying, hey, the machines are at it again. I'm not going to do anything this time. I've been fooled before, not again. And I actually think that people look at moves like this now very differently than they did 3 years ago. And they believe that they're not in any way fundamentally based. I think that the technicals, the algos, the machines, the people that we love to hate are chasing both headlines, but they're chasing fundamentals that are actually changing in the market. Let's be clear. I mean, if things were that positive out there, whether it's the multiple the stocks are trading at going into a fourth quarter where we're going to get probably downward guidance, whether we've got trade issues that haven't even hit our macro data yet, whether we've got the Fed that's at war or at least doing what it has to do. So I just
how much further do you think we have to go down?
I'll leave that to Carter. What I think, though, is we have to wait until we get some look into what 10% goes to 25% on tariffs, what ultimately happens on midterm elections, and really what we hear from corporate. There's no reason going into third quarter numbers where guidance is, of course, what we all know.
Well, we've already gotten some commentary from corporate America that should make people a little bit nervous, right? Whether it's PPG or Fluor, Fastenal,
or
Pepsi, FedEx, Macy's, Micron. I mean, the list is getting longer.
Right, and my point, so there have been 3 reasons to remain bullish, and today the fourth one is the fact that we basically closed at the 200-day. But the Fed could back away and sort of take a more dovish stand, which I think in the short term would be bullish, long term bearish. President Trump and President Xi could have some kumbaya situation where there's some accord. I think the market would take that as bullish. And maybe earnings will bail us out and you won't get the guidance that I think we're going to get. Those are the reasons to be bullish. I'm with Tim, though. I think something fundamentally has changed. You're starting to see inflation creep its head. Earnings are going to be, I think guidance is going to be weak. And I think the market heads down another 7 or 8%.
Let's not forget, right? The CPI, Karen, this week, it was cooler than expected. It's not like every data point is rip-roaring hot on the inflation front. It's just not the case. Now, maybe part of what we saw was because Powell the other day, or last week, or whenever it was recently, said we can go past neutral. And everybody freaked out and said, oh, my God, the Fed's going to raise rates, come hell or high water, regardless of what you're hearing from the Pepsis and the PPGs and the FedExes and everybody else.
I think that's a good point, Scott. And if anything, weren't we praying for a little bit of heat on CPI and PPI a couple of years ago? And there's plenty of folks out there that are very much in the deflation camp and think that that's really what this is, that we've never gotten out of a credit bubble, which is ultimately very deflationary, adding in the internet, adding in some other dynamics. I just think that the rest of the world is telling us something. And I don't think we can just fly in the face of that number. They're not rolling over hard. Europe's going to grow 2% this year. So this is more about, I think, where expectations still, though, need to be rebalanced somewhat.
Well, the point that Gundlach made to me yesterday was that the notion that we can just, if you want to use the word decouple from some of the weakness in Asia, China, and over in Europe, it's nonsense. It's eventually going to catch up to you and come home to roost. And now you're seeing the market here get upset the way that the markets overseas have been as well, Karen.
Yeah, I mean, I don't know. If we're in a period where you think bad news is bad news and good news is bad news, then okay, then the market will trade down. But, I look at things fundamentally, and I think that the bar has been lowered with this correction in the last few weeks. The economy, I think, is still really strong. We'll see. I think also sentiment can change very quickly. It changed to the downside. I think it could change the upside. I absolutely think the Fed should stay the course to reverse engineer this enormous experiment, which they've done, I think, quite successfully, and not have any little, bumps on the way out. Would be ridiculous to think they could do that.
Revisit what you said when we said, Tim's going to leave it up to you to say how much further we need to go. You said a lot of being
this is what you do here now.
or what's the real story?
It's about this. When volatility increases like this, is not what encourages the sort of Main Street investor to just plunge right in. It makes people back away. Also, you now have substantial losses both in your equity book and in your fixed income book, and that starts to also encourage money not to go after risk assets. And then finally, you get almost a 3% yield out of a 2-year note. None of that adds up to stocks off to the races. Downside, plenty prospectively, upside, quite limited.
So the beginning of next week will be part of a tell for all of you?
As much as the imagination can allow. Meaning, and the thing about sentiment is, it's just that it could change quickly. We only had 2-3 days of down sentiment. We've had years and years and years of up sentiment. And then there's things about breaks. You break once in February, you rally back, then you break again. That's distributive. That's what tops look like.